Have you ever looked at your pay slip here in Singapore and just wondered how it all works? Where does the money go? Well, today we're going to pull back the curtain on Singapore's income tax system and break down everything you really need to know. So let's start with the biggest question of all. What actually gets taxed here, and what's the logic behind it? You'll see it's a system built on some pretty clear and consistent principles. Once you get those, everything else starts to make sense. All right, here's our game plan. We're going to tackle this in 5 parts. First, we'll figure out what money is even on the table for taxes. Then we'll see how it's different for businesses. After that, we'll dive into the super important idea of being a tax resident. Then we'll put it all together to calculate a final bill. And last, we'll cover what you can do if you think they got it wrong.
Okay, first things first, let's talk about the absolute foundation of the whole system. What actually makes any of your income taxable? It really all comes down to a single, simple idea. Location, location, location.
And that idea is called the source rule. It's pretty straightforward. If you're earning money in Singapore from work you do here, that income is taxable. Simple. Now, if you earn money somewhere else in the world, but then you bring that money into Singapore, that's generally taxable too. The key is always the connection to Singapore.
Now, the tax authority doesn't just see all your money as one big pile of cash. They sort it into different buckets. So you've got your main salary bucket, maybe a side business bucket, a bucket for any rent you collect. You get the idea. It's all about making sure every different kind of income is accounted for properly.
Okay, this next point is absolutely critical to understand because it's a huge deal here. The money you make from your regular job or business operations, that's revenue, and it gets taxed. But let's say you sell a property or some stocks that you've owned for a while and you make a profit. That's a capital gain. And in Singapore, it's not taxed. This is a massive reason why Singapore is such a magnet for investors.
So we've talked about personal income. What about businesses? Well, it turns out that how your business is set up, its legal structure, makes a massive difference in how it's taxed.
This slide really shows you the fork in the road. On one hand, if you're a sole proprietor, the law basically says you are your business. Any profit it makes is just treated as your personal income. But a company? That's a whole different ballgame. It's seen as a completely separate legal person, and it pays taxes on its own profits, totally separate from its owners.
So what about other setups, like partnerships? Well, for the most part, they're what's called tax transparent. Just think of it like a clear piece of glass. The partnership itself doesn't pay any tax. The profits just flow right through to the individual partners, and they pay the tax on their share. Trusts are a bit of a different animal. They usually get taxed at the trustee level first.
All right, let's move on to something that can completely change your tax bill. And that's the question, are you a resident? Now, be careful here. This has nothing to do with your citizenship or your PR status. This is a specific definition used only for tax purposes.
So why should you care about this? Oh, it's a big deal. Because being a tax resident is your ticket to claiming all sorts of tax reliefs, deductions that lower your bill. Plus, you get taxed on a progressive scale, which often means a lower rate. Non-residents, they usually face a higher flat tax rate and miss out on all those reliefs.
So how do you become a tax resident? Well, the good news is you only have to pass one of these 3 tests. It could be about your overall lifestyle and connections here. Or it could be a straightforward numbers game. Were you physically in Singapore for at least 183 days during the year? That's it. Meet one and you're in. For companies, it's a different story. It's not about how many days they're here. It's about control. This classic legal principle basically asks, where are the big strategic decisions being made? Where does the central management and control actually happen? And usually that means wherever the board of directors meets to call the shots. Okay, we know what kind of income gets taxed, and we know who counts as a resident. So now let's put all the pieces together and see how the tax authority actually calculates your final bill. It's not just one step, it's a process.
The best way to think about this is like a filter. You start at the top with your statutory income. That's basically all your earnings poured together, minus any business expenses. Then it goes through the first filter. You subtract things like approved donations to get your assessable income. Finally, it goes through one more filter. You take out your personal reliefs. Whatever comes out the bottom is your chargeable income. That's the magic number that your tax rate actually applies to.
So for a resident individual, what is that tax rate? Singapore uses a progressive system. It just means the more you earn, the higher the tax rate you pay on that portion of your income. It starts at 0% and slowly climbs up
topping out at 22% for income above $320,000 a year.
Now for companies, it is so much simpler. Forget all those progressive bands. It's just one number, a flat tax rate of 17% on their chargeable income. That's it. This beautiful simplicity is a huge part of Singapore's appeal to businesses worldwide.
But let's be real, sometimes mistakes happen. What if you get your tax assessment and you think, hang on a second, that number doesn't look right? Well, the good news is you don't just have to accept it. There's a formal process to make your case.
Now, the process is all laid out, but here's the most critical part. The clock is ticking. You have exactly 30 days from when you get the notice to file your first objection. Don't miss that window. If you and the tax authority still can't agree, you can take your case up the ladder, first to a review board and maybe even all the way to the highest court in the land.
And remember, this isn't a one-way street. That time limit, it works both ways. The tax authority generally has 4 years to come back and say, hey, we think you paid too little. So it's always a good idea to keep your record straight.
So there you have it, a quick flyover of Singapore's income tax system. From the basic source rule to how that final bill gets calculated, it's a system designed to be fair, competitive, and clear. But it does leave us with a final thought. People say taxes are the price we pay for a civilized society, and that might be true. But how we set that price and who exactly pays it, well, that's a conversation that will probably never end.